Good morning and welcome to this wonderful chapter, Advanced Capital Budgeting. We are now going to start a new concept called Certainty Equivalent Approach, CEC, in short, Certainty Equivalent Approach. So in short we will write CEC, Certainty Equivalent Coefficient. Under this approach, what we do, instead of adjusting the discount rate, we are going to adjust the cash flows. Instead of adjusting the discount rate, we are going to adjust the cash flows. We will convert risky cash flow into its equivalent risk-free cash flow. Sir, what does that mean? It means how much risk-free cash flow you are willing to accept against risky cash flow. If cash flow is risky, you will expect more amount. But if I remove the risk element from that, you will be happy with a lower cash flow also. So under certainty equivalent coefficient approach, we convert a risky cash flow into its equivalent risk-free cash flow. For that, I have to tell you one story which is printed in the book also. So I am going to take the same story. Suppose you own a house. The story will make the concept clear. Suppose you own a house. You want to sell the house after 1 year. And you want to sell it for 6,20,000. Is this risky cash flow or uncertain cash flow? Yes. It is risky cash flow, it is uncertain cash flow because it is only my estimation that this house can be sold for 6,20,000, but it is my estimation. It can go wrong, it can change. I may get less than 6,20,000. Then your friend comes. Your friend says, I am willing to purchase this house. I am going to give you in writing, I am going to give you a guarantee that I am going to purchase this house from you after 1 year. Okay. Now, if cash flow is risky, you are going to calculate present value at risk adjusted discount rate. Let us say risk adjusted discount rate is 14%. Let us say risk adjusted discount rate is 14%, which means if the cash flow is risky, the discount rate will be risk adjusted discount rate. So my present value of cash flow will be 6,20,000 divided by 1.14. So can you do the calculation and give me the answer? This comes to approximately 5,43,860. It comes to approximately 5,43,860 plus minus 1 rupee is okay. So present value of this house is 543,860. My friend tells me he is willing to purchase the house, is going to give me the guarantee, and how much amount should I charge him? Should I charge him the same amount, 6,20,000, or should I charge him a lower amount? What is your view? A friend is willing to give me an assurance that he is going to purchase the house after 1 year for 6,20,000. Should I charge him 6,20,000 or should I charge him less than 6,20,000 or more than 6,20,000? What do you think? If somebody is willing to give you an assurance about purchasing the house after 1 year, you are going to charge him less amount. But how much less amount? Let us understand. Suppose risk-free rate is 6%. Suppose risk-free rate is 6%. if 5,43,000 is invested at 6% for 1 year, what will be the value of 5,43,000 after 1 year? It will be something like 5,76,492. Let us say 492. My friend is willing to give me an assurance he is definitely going to purchase this house after 1 year. So I am going to charge him 576,492 because my cash flow is now risk free. I can sleep peacefully because I know there is a person who is going to purchase this house after 1 year for this amount. So I have no uncertainty element left now. Now, moral of the story is that 5,76,492 risk-free cash flow is equivalent to rupees 6,20,000 risky or uncertain cash flow. Rupees 6,20,000 risky or uncertain cash flow. What is certainty equivalent coefficient here? Certainty equivalent coefficient here will be certain cash flow divided by uncertain cash flow. Certain cash flow in our example, type on your calculator 576,492, type on your calculator, divide by 6,20,000. So anybody who would be interested in replying? This comes to something like 0.93. Very good. 0.93. So what is the interpretation of 0.93? If uncertain cash flow is 1 rupee, if uncertain cash flow is rupee 1, its equivalent certain cash flow is 0.93. Management is willing to accept 0.93 against 1 rupee risky cash flow. If risky cash flow is 1 rupee, management is willing to accept 0.93 if the risk element is removed. So what we do in certainty equivalent approach, we convert risky cash flow into risk-free cash flow, and then we use risk-free discount rate to arrive at present value. Is it right? So Sajid Khan is also right, 0.929. So 0.929 is certainty equivalent coefficient. It means for rupee 1 uncertain cash flow, management is willing to accept 0.929 certain cash flow. 0.929 certain cash flow. Is it right? Suppose your institute says you have two choices. You appear in the exam on your own, you work hard, appear in exam, work hard, and whatever result you will get, we will give you. Second option is, institute says don't appear for the exam, we will give you 50%. This is uncertain, which you can get 70 also, 80 also, 90 also, but against this, if institute is willing to give you 50, you say yes, I am happy with 50, then this becomes certain cash flow. Now what is the use of this number? You will quickly reply, if uncertain cash flow is 1 lakh and certainty equivalent is 0.929, what is its equivalent certain cash flow? What is its equivalent certain cash flow? 1 lakh is uncertain cash flow. Certainty equivalent is 0.929. What is the equivalent What is the equivalent certain cash flow? Come on, reply. You have to just multiply 92,900. So I am willing to accept 92,900 against a risky cash flow of 1 lakh. So how do you get certain cash flow? You will get certain cash flow by multiplying uncertain cash flow into certainty equivalent coefficient. Very good, Divya. You will get 92,900. So this is the formula to convert uncertain cash flow into certain cash flow. So this will be step 1 in our answer. Convert uncertain cash flow into certain cash flow. And then step 2, present value of certain cash flow will be calculated using risk-free discount rate, because now the cash flow is certain. The discount rate should be risk-free discount rate. The discount rate should not include risk premium. Discount rate should not include risk premium. So I am going to use a risk-free discount rate, and the decision making rule is same. If NPV is positive, accept the proposal. If NPV is negative, reject the proposal. Okay. How do you interpret CEC? How do you interpret CEC? CEC will lie in the range of 0 to 1. The CEC would be in the range of 0 to 1. 0 means very risky and 1 means risk free. When your certain cash flow and uncertain cash flow both are same, the ratio will become 1. So if you are near 0, risk is more. If you are near 1, risk is less. Lower CEC means higher risk, and higher CEC means lower risk. For example, government bond. In government bond, they will pay you 1 lakh rupees interest after 1 year, and certain and uncertain both are equal only. So the answer is 1. ठीक है? And in case, suppose you have invested in shares of which company should I write? Dawn Limited. Shares of Dawn Limited. Suppose you invest in shares of Dawn Limited. 0 divided by 1 lakh. You are not going to get anything. Okay, if you go to receive money, they will say, so on the other extreme, we have a situation where it can be 0. So if you are on this side, risk is high. If you are on this side, the risk is low, because there will be a question whether the project is or whether the cash flows are more risky or less risky. Lower the CEC, higher the risk. Higher the CEC, lower the risk. Okay, so I have explained you everything. Now we have to solve question, but before that we will read the notes. You can get a theory question also on CEC. You can get a theory question also, like they can ask you write a note on CEC. While employing this method, just quickly read it. I have made a simple note for you. Institute material note is little different. While employing this method, the decision maker estimates the sum he must be assured of receiving in order that he is indifferent between assured sum and the expected value of a risky sum. So what CC do? It is a ratio of assured cash flow to uncertain cash flow. Under this approach, the cash flows are converted into equivalent risk-free cash flow. Risk-free cash flow means that cash flow which management is willing to accept had there been no risk. For example, a project will generate 20,000 cash flow if it is risky, but the management feels that it will get at least a cash flow of 12,000. So 12,000 is risk-free. If I ask you what will be the certainty equivalent here, you will say 12,000 by 20,000 0.6, which is written in your book also. This factor is called certainty equivalent factor or certainty equivalent coefficient. In some books they write CE, in some books they write CEF, in some books they write CEC, all are same. Range is 0 to 1. 1 means cash flows are fully certain, 0 means fully uncertain. Higher the risk, smaller will be CC, and larger the CC, the risk will be less. Distant cash flows are more risky, therefore certainty equivalent factor would be lower for them. For example, certainty equivalent factor can be 0.9 for year 1 cash flow, 0.8 for year 2 cash flow, 0.7 for year 3 cash flow. As we go into distant future, the risk will increase, uncertainty will increase, and certainty equivalent factor will decrease. Formula for computing certainty equivalent coefficient: it is the ratio of certain cash flow upon uncertain cash flow. Is it right? And if you want to calculate certain cash flow, multiply uncertain cash flow with certainty equivalent factor. For the purpose of computing present value, we will apply risk-free discount rate, because cash flow is risk-free, discount rate will be risk-free. Now come to the story I have explained. There is one story of a house which is to be sold for 6,20,000. Today you will read the story I have already explained. How to compute NPV under CC approach. Step number 1, convert uncertain cash flow into certain cash flow by multiplying by certainty equivalent factor. Step number 2, discount the certain cash flow by risk-free rate. Because cash flow is risk-free, discount rate should also be risk-free. If the NPV is positive, accept the proposal. If NPV is negative, reject the proposal. Between two options, the one which has higher NPV will be selected. Okay. Now the question is advantages of certainty equivalent method. Advantage number 1, simple and easy to understand. All of you have easily understood it, and the steps are also simple. Convert uncertain cash flow into certain cash flow by multiplying by certainty equivalent coefficient, and then use risk-free discount rate. It can be easily calculated for different risk level applicable to different cash flow, and easy to calculate, easy to apply. If the cash flow is more risky, you can have a lower CC for that, and if the cash flow is less risky, you can have a higher CC for that. And therefore easy to adjust cash flow and easy to calculate NPV using this approach. Now any query? No queries? Then we'll come to theory question: difference between risk adjusted discount rate and certainty equivalent factor. under risk adjusted discount rate, we will adjust the discount rate. Higher the risk, higher the discount rate, lower the risk, lower the discount rate. Whereas in certainty equivalent approach, we adjust the cash flow. We convert risky cash flow into risk-free cash flow, and then we use risk-free rate to arrive at NPV. So that is the main difference between RADR and CEF. Is it right? So now we are going to solve few questions on certainty equivalent approach. This question is there in the study material also. This question was asked in November 99 exam. Do you know the significance of this exam? The historical exam of November 99. Any guesswork? Why it is so important in the history of institute? Anybody would like to guess? No guesswork? Okay, I will tell you. In this exam, I had appeared November 99 exam, and this question had come in my exam also, and I had got rank also. Yes, you are right. So November 99 exam, this question was asked in our, that time it was called financial management. Now they are calling it advanced financial management. Question is still the same, numbers are still the same. Okay, so we'll come to question number 28. Thank you very much. AS Limited is considering investment in one of the two mutually exclusive proposals. What is the meaning of mutually exclusive proposal? Only one of the two can be selected. Only one of the two can be selected. Both cannot be selected. Project A, which involves an outlay of rupees 1,70,000, and Project B, which has an outlay of 1,50,000. The certainty equivalent approach is employed in evaluating the investment. The current yield on the treasury bill is 5%, and the company uses this as a riskless return. Why this is given? Why this 5% is given? Quickly reply. If you reply more, then I will tell you more stories. 5% is given to be used as discount rate. Expected value of the net cash flow with their certainty equivalent are Project A, these are the expected cash flow over the next 3 years, and this is the certainty equivalent. For Project B, these are the cash flows and these are their certainty equivalent. Which project should be acceptable to the company? The answer will be on NPV. The one which has higher NPV will be selected. Which project is riskier? How do you know? This question you can answer now also. Look at their CEC. Look at their CEC. Yes, Rajesh, you are right. Now tell me which project is riskier. The answer is already there in the question. No calculation required. Look at the CC column and tell me project A is riskier or project B is riskier. Yes, project A or B. Most of you have replied A. A is the right answer. Now you see, this is 0.8, this is 0.9. Year 1 cash flow is riskier than project B because CC is lower. Same thing for year 2 also. Lower CC, higher risk. Same thing for year 3 also. Or other way to compare is to take their total. This total is 2.0. This total is 2.3. So individual year also, if I see, the risk is higher in case of project A, and if I look at the total also, the total CC is lower for project A. Lower the CC, higher the risk. So answer for this question is project A is relatively riskier. Point number C, if the company was to use risk adjusted discounted method, RADR, suppose instead of using CC method, they want to use risk adjusted discounted method, which project would be analyzed with higher rate? Which project will be analyzed with higher rate? Answer please. If you have to use RADR method, which project will be analyzed with higher rate? The answer is again the same. Wait, the answer is still the same. If you are saying A is riskier, in answer B, you have to again answer A, because the one which is riskier will be discounted at a higher rate. So answer of B and C are same. They have only asked the same question in different way. You can't have answer A here and answer B. Then you are contradicting yourself. So answer A is right. Okay. So one by one we'll solve. I think I have given the format in your book only. So please write in the book. First, project A. Year, cash flow, in bracket risky, certainty equivalent factor, cash flow risk free, discounting factor at 5%, and discounted cash flow. Discounted cash flow means present value of cash flow. Present value. You can write present value if you are comfortable with the term present value. Column number 1, 2, 3. 4 is 2 into 3. 5. 6 is equal to 4 into 5. 6 is equal to 4 into 5. Okay, first you complete first and second column, copy from the book. What about the certainty equivalent coefficient of year 0? Always 1. Year 0 always 1, because the cash flow is in my hand right now. There is no uncertainty. Whether they give it or whether they don't give it, you will take year 0 certainty equivalent as 1. Understood? Now remaining they have given. Multiply please. 1,70,000. Risky cash flow into CC will give you certain cash flow. All of you will kindly reply also. 70,000, 55,000. Now we'll write factor 1 divided by 1.05. 0.9524, again press equal to 0.9070, again press equal to 0.8638. Now multiply and take total. Multiply and take total. Do it yourself. Give me the total. Give me total. Give me the total please. Total of the last column. One student has replied 9554. You are right. Don't worry. You are right. 9554 is also okay. 9554 is also okay. Approximately it should be right. Okay. Project B now. Project B. Previous answer is 9554 or close to that. Depending upon how many decimals you take. Pathan is also right. Very good, Pathan. Now try the next project B yourself. Project B, try yourself. This is the question. This is the question. Now you try the answer part. I'll give you 35 seconds to solve. 35 seconds to solve. Start. I'm not going to write anything now. You will solve. I will check. The one who will give the right answer will get first rank in the C exam. Once you have done the answer, you please inform me so that I can go to the next question. Once you have done, please inform me. Okay, have you completed? Student have got the answer, so I'll go to the discussion of 44256 is right. 44256 is also right. Very good. 44256 is right. So what I'll do, I will now compare the two answers and write the decision. Write down the decision. Write down the decision. Since the NPV of the project B is higher, project B should be accepted. Since NPV of the project B is higher, project B should be accepted. Project B should be accepted. Then write down second answer. Second answer is which project is riskier. Write down for that part certainty equivalent coefficient. Certainty equivalent coefficient of project A is 2.0. Is 2.0. Is 2.0. How this 2.0 has come? Write in the bracket, that is 0.8 plus 0.7 plus 0.5, which is lower than project B 2.3, which is lower than project B 2.3. How this 2.3 has come? Write in bracket, that is 0.9 plus 0.8 plus 0.6. This means that project A is riskier than project B. Project A is riskier than project B as in inverted commas, higher the riskiness of cash flow, lower will be certainty equivalent factor. Higher the riskiness of the cash flow, lower will be the certainty equivalent factor. Lower will be certainty equivalent factor. Lower will be certainty equivalent factor. One more line write down. One more line. Also, we can see that for each individual year, the CC of project A is lower than project B. For each individual year, CEC of project A is lower than project B. Is right? So this is my second answer. The third answer is, if you were supposed to use RADR, which project will be analyzed at a higher rate? The answer is same, because if you are saying A is riskier than B, then discount rate for A will be higher than that of B. So write down point number 3. Point number 3, if RADR method is used, project A would be analyzed with a higher rate. Why? I have written the reason also. You can write that if you want. The reason is the cash flow from a more risky proposal. Should be discounted at a relatively higher discount rate. As compared to other proposals whose cash flows are less risky. So that is how you will write a comprehensive answer. You will get around 6 to 8 marks for this ordinary simple question. Can you believe that? You have to believe it, because this question was asked in my exam. Question number 29, exactly same question. Only the institute have multiplied these numbers by 5 times. What a creativity! Clap, clap, clap. Homework. Question number 30. Again same problem. Here the figures are also, I think, same. So you can just do one of the two only. If the figures are 100% same, you can do one of the two. Previous question was in the study material. This question was in November 2020 RTP, March 21 MTP. Okay. Question number 31. This I will solve. Please must do in notebook 2 questions, because they are 100% same. I have no value addition to be done. Question number 31 will solve in the book only. Ranbaxy is planning to introduce a new anti-diabetic drug. This would entail an initial investment of rupees 30 lakh. Initial investment is given 30 lakh. The product is expected to be in market for 4 years, and net cash inflow for year 1 through 4 are expected to have the following probability distribution. Year 1, these are the cash flows, these are the probabilities. Year 2, these are the cash flows, these are the probabilities. Year 3, cash flows, probabilities. Year 4, cash flows, probabilities. Which means first I will have to find out expected NPV. First I will have to find out the expected NPV. After computing expected, not NPV, cash flow. First I have to calculate year 1, 2, 3, 4 expected cash flow. After that, second step, you will multiply by certainty equivalent factor and then discount it at 6%. Compute the NPV of the investment in the new anti-diabetic drug by Ranbaxy. Is it right? So please come to the answer. My first step would be find expected cash flow. Second step, find risk-free cash flow. And the third step would be to compute the NPV. Is it right? Source, write down reference book. This question have not been asked in any of the institute's publications, but I found it to be a good question. We thought we'll solve it in the class also. So let us write down step 1, calculation of expected cash flow. Year 1, year 2, year 3, year 4. First you will copy from the question cash flow and probabilities, which I have done it for you because your time is precious. Now multiply 8 into 0.3. Please reply quickly because I have not got the answer of this question. 2.4, 10 into 0.3, 3, 11 into 0.4, 4.4. Now can you please tell me the total? Is it 9.8? Just confirm. Is it 9.8? Yes. Now 3, 4.8, 4.5. Total. Is it 12.3? Please confirm. Then anybody for year 3? Is it 17.8? Okay, very good. Try the next year. $15.5. Do you confirm this? Yes. Now please use these numbers in the next answer now. Use this number in the next answer. Next answer is calculation of NPV using CEC approach. Calculation of NPV using CEC approach. So now first you bring this expected cash flow in this working and then multiply by certainty equivalent coefficient 30 into 1. Then you multiply 9.8 into 0.84. This is 8.232. 12.3 into 0.80. 9.84. 17.8 into 0.76. 13.528. 15.5 into 0.71 is 11.005. Please tell me whether this is right. Are these numbers right? Okay. Now I'll go directly to the last column and I'll calculate the present value directly. How do I do it? Very good, Sajid. I will take 8.232 divide by 1.06 equal to memory plus also. So something like 7.766. Then I will type 9.84 divided by 1.06 2 times equal to memory plus 8.758. Then I will type 13.528 divided by 1.06 3 times equal to memory plus 11.358. And I will type 11.005 divided by 1.06 4 times equal to memory plus 8.717. Memory recall minus 30 equal to approximately 60. This is NPV. So please check. I have done myself. I don't know whether it is right or not. Anybody who got same answer? 6.60. Very good. Other student can also try. This way you have to solve. Only with lot of practice, lot of dedication, you will be able to get through this exam. And for that you don't have to watch the video. You have to write in the notebook. You have to write in the book. Okay. So this answer is over. Only write the advice. Project should be accepted because NPV is positive. NPV is positive. 6.599 is also right, don't worry, because NPV is positive. Positive NPV increases the wealth of shareholders. Positive NPV indicates that you are earning more than your cost of capital or your required rate of return. So it increases the wealth of the shareholder. The goal of financial management is wealth maximization. Positive NPV is an achievement towards that, a step towards that goal of wealth maximization. Hence, we always say when NPV is positive, except. Reason, wealth maximization. One more question, number 32, will solve in the book. There is a small printing mistake in some books. These numbers you have to shift one line above, or maybe you can shift this year column one line below, whatever helps you to understand. What is appearing on the screen is the correct presentation of the question. It says Apple Software Company is evaluating a proposal of which the cash inflows are not certain. The firm has decided to apply the certainty equivalent factor, which reduces by 0.05 every year, which means it will be 1 in the year 0, but it will keep on reducing by 0.05, so it will become 0.95. However, the cash flow of first year is expected to be known with certainty. Cash flow of the first year is known with certainty means we will take 1. When a specific instruction is given, find out the NPV of the proposal at 10% discount rate, the relevant cash flows are given. Now in the exam, they are only going to give you these two columns. This column I have added. Okay, read the problem. Cash flow for first year is expected to be known with certainty. So I have written 1, which reduces by 0.05 every year, 0.95, 0.90, 0.85, 0.80, 0.75. Okay. Write down source of this question, reference book. Not in any of the institute publication. We have to really work hard to find out a variety of questions for you, because what is new in this question is this line, that CEC reduces by 0.05 every year, but the first year CEC will be 1 because it is certain cash flow. Now please all of you participate in the discussion and compute the risk-free cash flow. Okay, 40,000 into 1, 38,000 into 0.95, 36,100, then 36,000 into 0.9 is 32 34,400, 34,000 into 0.85 is 28,900, 32,000 into 0.8 is 25,600 and 30,000 into 0.75 is 22,500. Okay, now I'll directly go to this column and we can get the present value directly. This is 1 lakh because year 0. Now you type 40,000 on calculator, divide by 1.10 equal to memory plus 36364. You can round off. Okay, then you type 36,100 divide by 1.10, 2 times equal to memory plus, round off, 29835. 29835. Is it right? Okay, next one, 32,400 divided by 1.10, 3 times equal to memory plus 24,343. Then next is 28,900 divided by 1.10, 4 times equal to memory plus 19,739. The next 25,600 divided by 1.10, 5 times equal to memory plus 15,896. Okay, one more, 22,500 divided by 1.10, 6 times equal to memory plus 12,701. Memory recall now, memory recall minus 1 lakh equal to, answer please, answer check. I have got 38,876. Please confirm, is this right? Is this right, everybody? Yes, 38,876. Advice, write down yourself, copy from the previous question. Advice, the company should accept the project. The company should accept the project because NPV is positive, positive NPV increases the wealth of the shareholder. Positive NPV increases the wealth of the shareholder. Sajid Khan is also saying 38,878. Wonderful. Positive NPV increases the wealth of the shareholder. On this, one more question is there. Question number 33. Homework. Question number 33. Write down homework. Okay. This question is from study material November 2018 RTP and similar question in May 2020 RTP. The source of these questions are past ICI exams in intermediate and final, past RTP of inter and final, past MTP of inter and final, past study material, past and current, I will not use the word past, study material of inter and final, because this topic was there in intermediate also some time back. It was there in the old to old course also. So based on all those questions, we have compiled this note topic wise, concept wise at one place. So you don't have to search here and there. All questions at one place. Question number 33 homework. Question number 34 homework. Very small simple question. Now we'll solve something very important. They have asked this question in the past CA final exam for I think it was 8 marks, November 18 exam. So this time they have asked you a really good question on capital budgeting. So have you marked it very important, right? Have you kept 4 pages blank for homework? First you keep 4 pages blank. 1, 2, 3, 4 pages blank. Now write down question 35 so that you are reminded that you have to do homework. Question 35. Airborne Limited wants to take advantage of a new government scheme of connecting smaller towns and wants to purchase one turboprop airplane at a cost of 5 crore. Initial investment is 5 crore. Initial investment is 5 crore. It has obtained permission to fly on 4 sectors. This will not impact my answer. The company had provided the following estimate of cost and revenue. The cost of capital is 16%. And the company depreciates its asset over a period of 25 years on straight line basis. 5 crore divided by 25 years. Can you tell me how much will be depreciation per annum? Yes, try 5 crore. Type 5 crore divided by 25. How much will be depreciation? 0.2 crore. 0.2 crores or 20 lakhs. That's right. So I will require depreciation because of taxation. Now it is saying currently it is operating in a 30% tax regime. Under the new government scheme, it enjoys 100% tax waiver for first 3 years. Underline. While calculating taxation, do not calculate taxation for first 3 years. Do not calculate tax for first 3 years. Passenger capacity is 60 passenger. Small aircraft. 60 passenger means very small aircraft. But the operational capacity is going to be 80%. Expected operational 80. So you will not get 60 passenger. You will get 60 into 80%. You will get 48 passenger only. Per aircraft number of trips on a daily basis 4. So number of passenger multiplied by 4 will give you total number of passengers travelled per day. After calculating total number of passenger per day, you will multiply by average realization per passenger 2000. So that will give you revenue per day. That will give you revenue per day into 365 days will give you annual revenue. So how do you get annual revenue? 60 passenger into 80% into 4 trips per day into 2000 into 365. Oh my God. Now it says annual cost of manpower. This is your salary, wages, etc. 2 crore 50 lakh. Airport handling charges fixed per day. Per day multiply by 365. 10,000. Annual repairs and maintenance 5 crore. Daily operating cost, daily. If daily is given, per day is given, multiply by 365. Okay. So this I'll multiply by 365. This I'll multiply by 365. This revenue I'll multiply by 365. the cost with the exception of, carefully read, cost with the exception of airport handling charges. This is not applicable to this line. This line, the cost with the exception of airport handling charges are expected to increase by 10% year on year. This cost will increase. This cost will increase. This cost will increase by 10% year on year basis, and the operational capacity will go up to 90% from year 3. So you see, it was 80%, but it is 80% only for 2 years, first and second year. Thereafter, the capacity would be 90% from year 3. Lot of data crunching will be done. The certainty of achieving the projected cash inflow in the first 5 years are, these are the certainty equivalent: 0.8, 0.9, 0.75, 7 and 0.7, and these are the PV factors given: 0.862, 0.743, 0.641, 0.552, 0.476. So we are going to use this as a discounting factor. Advise the management on the feasibility of the project, assuming the aircraft operates on all the 365 days in a year. Okay, now what should we do? This question has not given us risk-free rate. This question has not given us risk-free rate, but they have given you certainty equivalent factor. So we are going to use the same factor in the problem for discounting purpose. Nothing can be done. Plus, although the life of the project is 25 years, or this life of aircraft is 25 years, but from the drafting of the question, we have to check within 5 years only will the project generate positive NPV. So there are two limitations in this question. One is they should have given risk-free rate. They have given you cost of capital. Second, they should have given more information about future 20 years, but they have given you data only for first 5 years. Hence, we are going to evaluate the project based on 5-year cash flow. You will write in the notebook so that you will understand better. I would request every student to first write in notebook. First, we will make a small working note: depreciation. Please write down in your notebook, not the study material, notebook. Depreciation per annum. Depreciation per annum. Depreciation per annum will be 5 crore is the cost of the aircraft divided by 25 years. So depreciation would be 20 lakhs per annum. Depreciation would be 20 lakhs per annum. Next point is realization from the passenger. Realization from the passenger. That means how much revenue you will earn per annum. So write down year 1, 2, 3, 4, 5, because the CC factor, present value factors, they are given only for first 5 years. So are you writing? It is like service costing in question, in costing, very good. But there I think the discounting was not done. I am not sure whether discounting was also done in service costing, and secondly, the certainty equivalent factor was not there. Okay, so it is a mixture of service costing and capital budgeting. Costing and finance are two closely related subjects. They are not very different. In finance, we just take the same input and we also consider time value of money in the decision making. and that becomes financial management. Write down year 1, year 2, year 3, year 4, year 5. First point A, write down passenger capacity. One day you will become, suppose, CFO of Jet Airways or Indigo Airline or SpiceJet. This is how they do the evaluation before they start a particular sector. Okay, so they have given you all basic input that is usually used by the airline companies in order to decide whether they should run the aircraft in a certain route or not. Good question, at least for understanding the business model of airline business. Now write down point number B, expected operational capacity. Expected operational capacity, first and second year 80%, then it will be 90% from third year onwards. 90%. Point number C, number of trips per day. Number of trips per day, 4 trips. Number of trips per day, 4 trips. Then average realization per passenger. On an average, how much fare they are going to charge. They have written 2000. Then write down number of days. Number of days, 365 days written in the problem. What is your task now? Multiply all the 5 variables. Multiply all the 5 variables and that will give you annual revenue. Okay, revenue for each year. So point number F, write down realization. Under that write A into B into C into D into E. Take your calculator imported from China and calculate. First answer please. First answer please. First answer please. 14 crore 1,60,000. Yes. Second answer same. Second answer same because data is same. Third answer calculate and copy paste in fourth and fifth also. So anybody for the third year? Anybody for the third year? Anybody for the third year? 15 crore 76 lakh 80,000. Copy paste because data is same. Don't waste time again. Is it right? All 5 numbers are same. Very good. Those who are replying, they are good student. Those who are not replying, they are very good student. Point number 2, write down statement showing cost. Statement showing cost. Now we have to do the costing also. Sometimes I forget whether I am a costing teacher or FM teacher. Annual cost of manpower is 2 crore 50 lakh. Wait, it will increase by 10% every year, plus 10%, plus 10%, plus 10%, plus 10%. Okay, then airport handling charges fixed per day 10,000 into 365. 365 into 10,000. And will it increase? It will not. The problem says with the exception of airport handling charges, this will not increase. This will not increase. This will remain constant. Next, annual repairs and maintenance. This is given 5 crore. Will increase by 10%. Come on, plus 10%. 5 crore 50 lakh plus 10%. 6 crore 5 lakh plus 10%. 6 crore 65 lakh 50,000. Last one, 732,05,000 is the answer, right? Point number D, write down. Point number D, daily operating expense. Daily operating expense. Daily operating expense will be 75,000 into 365, 2 crore 73 lakh 75,000 plus 10%, plus 10%, plus 10%, plus 10%. Check the answer. Is it correct? Check the answer. Is it correct? Just inform me, is it correct? Is it correct? Now you have to take the total. Just add A, B, C, D. Take the total. First year. Lengthy question. If it is asked, you will get 8 to 10 marks if you are well prepared. So please tell me total of the year 1. 10 crore 60 lakh 25,000. Is it correct? Second year total 11 crore 62 lakh 62,500. Is it correct? Third year, do yourself. Third, fourth, fifth, do yourself. Third, fourth and fifth you will do yourself, then I will check. Please solve third year. Everybody. Third year. Very good. Fourth year. Fourth year. Fourth year. 139911125. Just confirm, is it right? Is it right? Okay. Fifth year. Fifth year. Sorry. Fifth year. Fifth year. Check the answer. Confirm. Yes or no. 15 crore 35 lakh 37,238. Very good. Now what we'll do, we are going to compute NPV. So write down our next heading, statement showing NPV. Statement showing NPV. Statement showing NPV. Right hand side 5 columns, year 1, year 2, year 3, year 4 and year 5 and year 5. If you have scale, you can draw the lines. Okay. First you have to write realization, means revenue. Where will you go? Step 1. Go to step 1, revenue working note, and copy from there the last line. You will find 14 crore 1 lakh 60,000 in the first and second year, and in the third, fourth and fifth year, your expected revenue is 15 crore 76 lakh 80,000. Is right? Then you will write down point number B, cost of operation, step 2. Total cost. You can simply write total cost. Total cost, write down. Total cost, step 2. Total cost, step 2. Go to step 2 and copy the last line. Go to step 2, copy the last line. And depreciation, working note we have prepared in the beginning. Working note we have prepared in the beginning. working note we have prepared in the beginning, 20 lakh. Then you write down profit before tax. Profit before tax. You can give point number A, B, C, D. So this will be A minus B minus C. A minus B minus C. Just check the calculation. Don't copy. Don't copy. 3 crore 21 lakh 35,000. Year 2, 2 crore 18 lakh 97 500. Year 3, 2 crore 81 lakh 56 250. Year 4, yes, year 4, 157 68 875. Come on, year 5. Year 5, 2142 762. 2142 762. First check whether you got it right. Profit before tax. Point number E, tax. What about first 3 year? Government of India has this scheme. If you run airline in certain route, first 3 years tax exemption as per the question. So first 3 year dash, 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 and then you have to pay 30% tax. Tax at the rate 30%. So please take this number into 30%, 47 lakh 30,663. Then in the last year, 6 lakh 42,829. 6 lakh 42,829. Now write down profit after tax. Point number F, profit after tax. Come on, profit after tax first year and second year and third year I will tell you without calculator. Check my ability. First year 321 lakh 35,000. Second year 2 crore 18 lakh 97 500. Yeah. Third year 2 crore 81 lakh 56 250. Yes, without calculator. Two easy ones you will try. The last two easy ones you will try. Anybody for the fourth year? Fourth year, PAT 1 crore 10 lakh 38,212. Very good. Very good. Next, last one. Last one. Come on. Very good. Last year. Last year is how much? 14 lakh 99,933. 1499 993 933. And now write down add back depreciation. Depreciation add back 20 lakh. So now you will get CF80. Now you will get CF80. Write down point number H, CF80, F plus G. CF80, F plus G. CF80, F plus G. First year, second year, third year, fourth year, fifth year. But in this question there is one more adjustment. You have to convert into certain cash flow. They have given you certainty equivalent factor, and if they have given, you will have to give full respect. These are the factors given for different years. Follow the question. 0.8, 0.9, 0.75, 0.7 and 0.7. There may be some typic mistake in your book, you can rectify. And after that you multiply CFAT with certainty equivalent cash flow, certainty equivalent factor, you will get certain cash flow. You will get certain cash flow. You will get certain cash flow. Please multiply H into I. H into I. Multiply the two. 2 crore 73 lakh 8,000. Please check the answer. Don't copy. Second answer, anybody? Second answer. Second answer, please. 2 crore 15 lakh 7,750. Then third answer. Third answer. Fourth answer. And fifth answer. Do not copy. First check. Then write. This is called certain cash flow. This is called certain cash flow. And they have given you PV factor also. When they have given you factor, don't use your own calculation. Use the factor given in the question. Use the factor given in the question. Point number L, write down PV of cash inflow. PV of cash inflow. Please multiply J into K. Please multiply J into K. J into K, and use memory plus function. Use memory plus function. You will require total. You will require total. Multiply equal to memory plus. This is the first answer. Check memory plus. Second answer. Check memory plus. Third answer, memory plus. Fourth answer, yes, memory plus. Fifth answer, memory plus. Got it? First check the numbers, do not copy. One day if this question is asked in the exam, if you have done practice in writing, you can easily score full marks. If you think you will read the answer and you will understand everything, of course you are too optimistic person on this planet Earth. Now take the total. First you draw one line completely here. This table is over. And now below the table, write down total PV of cash inflows. Total PV of cash inflows 6 crore 2,21,515. Wait a minute. First you confirm that this total is equal to this amount. Memory recall. Confirm please, then I'll go ahead. Confirm, then I'll go ahead. This is right. Very good. Less PV of cash outflow. Less PV of cash outflow. Less PV of cash outflow 5 crore. Therefore NPV will be 1 crore 2,21,515. 1 crore 2,21,515. So within first 5 years only, the NPV is positive, and you can use the project for 25 years. So of course NP will be much higher than this. So what is your conclusion? What is your conclusion? Should we purchase the aircraft? Write down advice. Write advice. advice, write down. Since NPV is positive, Airborne Limited should accept the project. Airborne Limited should accept the project. Is the answer right now? Very good, Pathan, you are right. Do you agree with this answer? Yes. Welcome to sensitivity analysis. Okay. This is another highly tested area in this chapter. Sensitivity analysis indicates that there are so many factors which affects the NPV, and all these factors we are estimating. If the estimates change, your NPV can be affected. So we want to understand to what extent these factors can change before the NPV becomes negative, or sometime we test if this factor changes by some percentage, by what percentage the NPV can change. So there are two types of questions we are going to solve. One is, by what percentage initial investment can rise and my NPV will become zero? By what percentage material cost can rise and my NPV will become zero? Beyond that, NPV will become negative. The second type of question they will ask you, if initial investment increases by 10%, how much will be the impact on NPV? Or if life of the project is 3 years instead of 5 years, what will be the impact on NPV? Or if the discount rate instead of 10 had it been 12%, what would be the NPV and what would be the percentage change in NPV? So both way question can be asked. You have learnt in capital budgeting chapter that NPV is affected by several variables like cost of the project, initial investment. If this goes up, NPV will go down. Material cost, if it goes up, NPV will go down. Discount rate, if this goes up, NPV will go down. Sales, if sales go down, NPV will go down. Project life, if this is lower than what is expected, NPV will fall. If other cost increases, NPV will decrease. I have written some factors only. When we are doing sensitivity analysis, we have to look at downside risk only, not the upside gain, because we are analyzing risk. For example, the sales can increase also, the sales can decrease also. But to understand the riskiness of the project, what I am going to do, I am going to check if sales decreases by so much percentage, what will happen to my NPV, or what should be the maximum decline in sale accepted so that NPV does not become negative, right? We will only look at the downside risk, not the upside gain. Material cost, for example, material cost can rise also, material cost can fall also, but my NP will be adversely affected if material cost rise. So two types of question we will solve. One is, what is the maximum increase in material cost in percentage term so that my NPV does not become negative, or if material cost increases by 5%, by what percentage my NPV will be affected. So that is called sensitivity analysis. So I'll just read the definition. You can get theory question also. Write a note on sensitivity analysis. Then you have to write this much. Sensitivity analysis is used in capital budgeting for measuring the risk more precisely. As we'll see in some problem, it helps us to understand that the project is sensitive to which of the variables and by what percentage. Okay, it helps in assessing information as to how sensitive are the estimated parameters of the project, such as cash flow, discount rate, project life. These are all my estimated numbers, because once I start the project, actual outcome can be different to the estimation error. Suppose if sales cash flow decreases by 2%, NPV becomes 0. If discount rate increases by 10%, NPV will be 0. If project life is reduced by 2% or 20%, NPV is 0, which means project is more sensitive to cash flow. Only a 2% decline in cash flow can result into 0 NPV. Beyond 2% decline can result into negative NPV. Project is relatively less sensitive to project life, because here we have a margin of 20%. If the life of the project declines more than 20%, then the NPV can become negative. So then we are able to understand which variable is more sensitive, which can cause a more impact on NPV by doing this sensitivity analysis. Future always is uncertain. Who knows it better than you? And estimations are always subject to error. Because I was expecting I will get 10th rank, I got 24th rank. Such a sensitivity is there in our ranking also. Same thing can happen in project also. Your cash flow, discount rate, life, material cost, tax rate, all those variables which you estimated can go wrong. Sensitivity analysis takes care of estimation error by using a number of possible outcomes in evaluating a project. So we are going to see if this variable changes by so much percentage, how the NPV can change, and based on that the management will understand the risk. Once you know the risk, you can take a more informed decision. Is it right? Once you know the risk, you can take a more informed decision. Sensitivity analysis is a technique of risk analysis which studies the responsiveness of a criterion of merit like NPV or IRR to variation in underlying factors. Same thing they are repeating. It measures how NPV or IRR can change if there is a change in important variables like selling price, quantity sold, return from investment, etc. Sensitivity analysis answers questions like, we are going to solve all this discussion in numerical format. Suppose if the cash flows decrease to 50,000 instead of expected 80,000, how the NPV will be affected? Sensitivity analysis answer questions like, what will happen to the NPV of the project if the life of the project is only 3 years instead of 5 years? Okay. In terms of capital budgeting, the possible cash flows are based on 3 assumptions. One is cash flows can be worst, which is called pessimistic. Cash flows can be most likely, means average, expected, and cash flow can be most optimistic, when things are very good. So the cash flows can be pessimistic, most likely, or optimistic. Sensitivity analysis involves 3 steps. First, we have to find out in a given question which variable will influence IRR or NPV. Mostly we take NPV only. Like for example, which factors can influence NPV? One is the project cost, then life of the project, cost of capital, selling price per unit, sales quantity, material cost, labor cost, overheads, then tax rate. Is it right? Salvage value, etc. I have made a small list of those factors which can affect the NPV of the project. Then we will find out a definition of the underlying quantitative relationship among variable. Quantitative relationship means how is NPV calculated. So NPV is equal to, for example, cash flow multiplied by PV annuity factor minus project cost. And again, cash flow depends on selling price, sales quantity, material, labor, overhead, tax rate, salvage value, etc. So all this mathematical formula I will write, which helps me to compute NPV and analyze the impact of change in each of the variable on the NPV of the project. If selling price change, if quantities sold change, how the NPV will be affected. So basically, just like in your offices on Excel sheet, the client says, if my income is this much, how much is my tax liability? So what you do on Excel sheet, you make a formula, all income, deduction, taxable income, tax rate, etc. And then client says, if this is my income, how much tax liability? Same thing I am going to do. If this is my selling price, how much will be my NPV? If this is my material cost, how much would be my NPV? So I can check the sensitivity. Then I have written in your book, method of computation. Sensitivity is computed as a ratio of downside change in input parameter to the value of initial parameter. Sir, what does that mean? Why do you write such complicated lines? It simply means change divided by base. Change means if the value changes, for example, let us say sales quantity. Let us say sales quantity. Okay. If sales quantity changes, by what percentage, or what is the percentage, what is in terms of percentage change? So change in sales quantity is suppose 200 and original quantity estimated is 1000. So this will be 20%. If sales quantity changes by 20%, NPV will become 0. NPV will become 0. That is called, I can allow my sales quantity to fall by a maximum of 200. But if it is expected to go down beyond 200, then NPV will become negative. That is what you have to compute. That is very simple meaning of this first line. In sensitivity analysis, one of the drawbacks is that we are going to test one variable at a time. If I am testing the sales quantity for sensitivity, all other variable will be held constant. That means they will be assumed not to change. Only one quantity, one variable will change at a time. What we'll do, we have to find out what should be the value of that variable at which NPV will be 0. So it's a reverse working problem. NPV should be 0 and you have to find out the respective variable at which NP will be 0. For example, if you are testing sales quantity, how do you compute NPV? Selling price minus variable cost into quantity sold minus fixed cost will give you your profit, and if you have depreciation, minus depreciation also. If you have depreciation, then minus depreciation, that will give you PBT, and that you multiply by 1 minus T will give you PAT, and you will add back depreciation, you will get CFAT. You will add back depreciation, you will get CFAT, and that should be equal to 0. Sorry, that will be multiplied by one more thing. This whole thing you multiply by PV annuity factor minus project cost, and that should be equal to 0. This is my, basically you can say, equation for finding NPV, but it can change from question to question. I will take all other variable, okay, from the question. This I will keep it as X. If I am testing quantity sold for sensitivity, and suppose after solving this equation I require a minimum quantity to be sold 800. My original estimate is 1000. So change is 200. Change divided by base, 200 divided by 1000, 20%. So 20% is my sensitivity. 20% is my sensitivity. Point number next. The extent of change so determined is expressed as a percentage. The process is repeated for all critical variable. So if I want to test selling price, I can do that. If I want to test variable cost, I can do that. If a variable is likely to undergo change beyond the levels tested, the project is reviewed afresh. The project is reviewed afresh, which means if suppose my answer comes to only 2%, 2% drop in sales quantity will result into 0 NPV, more than 2% will result into negative NPV. I have to sit down and think again. Oh my God, even though it is generating positive NPV right now based on 1000 quantity, but if the quantity falls by just 20 units, which is very much possible in future, my project can be a loss making project. So I will think twice when I find that the percentage change for a particular variable is very small. Sensitivity always measures the downside risk, not the upside gain. The formula for sensitivity, change upon base. Change upon base. Advantages of sensitivity analysis. First is management can identify those critical factors which can affect the success or failure of the project, like sales quantity or selling price. They are critical variable, so a small change in them can make your project a negative NPV project. Second, it is a simple technique. You can also apply it. As we will solve the problem, you will find it is very easy, because we are only changing one variable at a time, keeping other variables constant. Then what is the disadvantage? Disadvantage of sensitivity analysis is that it assumes independence of variable. only one variable will be tested at a time, other variable will be kept constant. But in reality, more than one variable can change at a time. Selling price can reduce, at the same time material cost can increase, quantity sold can decrease. So multiple factors can change at a time, but this sensitivity analysis says only test one variable at a time. This does not take into account the probability of changes in the variable. So we are not going to discuss probability here. Sensitivity analysis measures the risk, analyzes the risk, tells you more about risk, but does not eliminate the risk. It does not do anything to eliminate the risk. It only gives you an idea about various factors which can impact the project in different ways. So how to take decision? Lower the change percentage, higher the sensitivity. Suppose sales quantity, if falls by 2%, will make NPV 0, and if cost of project increases by 30%, then NP will be 0. Project is more sensitive to sales quantity and project is less sensitive to cost of the project. In case of sales quantity, we have a margin of safety of only 2%. We can make an error only up to 2%, because if quantity sold is more than 2%, quantity sold drops by more than 2%, the NP will become negative and it may lead to reversal of investment decision. Some example is written in the book. If NPV were to become 0 with a 1% change in fixed cost relative to 10% change in sale, we will say project is more sensitive to fixed cost. Is it right? So this is about the theory part of this chapter. Today we'll stop here. We'll continue tomorrow. Today is Ganesh Visarjan in Pune. Okay, it's a big festival here, big celebration day here. All the roads are blocked, and I don't know whether I'll be able to reach my home also properly or not. So I will try to leave as early as possible from the office and then I'll reach. Okay, so see you day after tomorrow, because this celebration will continue today and tomorrow morning also. Tomorrow the roads will be completely blocked. I will not be able to reach also. So see you day after tomorrow. See you day after tomorrow. Okay.